Hi everybody, Thomas Moore at Rebel Income. Lately I've been following the thread of dividend sustainability for some of the most recognizable names in the stock market, especially if their dividend payout right now is significantly higher than normal. It's easy to gravitate to dividend paying stocks that offer the highest yields, but like fool's gold, I've found through my own experience that in many cases these high yields can set average investors like you and me up for disappointment, especially if the company's underlying business isn't strong enough to sustain the dividend. That brings us to today's spotlight, Dow Incorporated. This is one of the most established companies in the United States with a history that goes back more than 100 years and an unquestioned global leadership position in the chemicals industry. Their dividend currently offers an annualized yield above 6%, which is well above the S&P 500 average as well as what is available in most treasury bonds. Does that mean that this titan of U.S. industry is a reasonable substitute for bonds? If the company's business is strong enough to support its dividend, does it also offer a useful bargain opportunity at its current price? We're about to find out. Before we dive into the details, I want to invite you to visit my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades that I publish for my trading alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions as well as current market conditions. You'll find the link in the description area of this video. Take a look. I know you'll be able to find something that you'll be able to use in your own trades. Dow's long-term trend over the past year is moving mostly sideways. We can see a lot of volatility in the overall price as it swings from high to low. However, that sideways trend is more easily seen when you look at the 200-day moving average, which is flattened out and is mostly moving in a sideways pattern right now. Since October, the stock has picked up quite a bit of bullish momentum, rallying from a low at around $47 per share to a peak in early January at around $56 per share. After retracing back a little bit in the early part of this month to a low at around $52, the stock has picked up a new set of bullish momentum that has put the stock right now right at around $54.50. The most interesting part of the stock's current price action is what happened today, with the stock seeing a pretty sizable increase that created what is known as a bullish engulfing candlestick that looks something like this. This is generally a very bullish indication that should indicate a higher than average likelihood that the stock should continue to move upwards for the time being. That kind of momentum begs the question of just how much more room the stock has before it runs into its most immediate resistance. For now, that level looks to be right at around that $56 peak that formed at the beginning of the month. That's about $1.50 away from the stock's current price. If the stock does reverse and begin to fall, the question is, where is the most immediate support level? Well, right now the 20-day moving average is starting to go down and beginning to flatten out just a little bit, and is currently sitting right at around $53.50, about $1 away from the stock's current price, which puts the stock's short-term downside at about $1 per share right now. That means that if you're trying to think about using Dow for a near-term kind of a trade based on momentum or swing trading principles, the reward to risk in this stock is about $1.50 on the upside versus about $1 on the downside. That means the overall reward to risk ratio, literally speaking, is 1.5 to 1. That's not a great amount of opportunity considering the amount of risk involved. We usually want to see that at least 2 to 1 for a solid short-term trade. All of that said, the stock's upward trend since the end of October does give the stock some bullish momentum that it does appear to be building on. And that could lead to a good opportunity for a long-term oriented investor who may be interested in the stock's dividend, which goes back to the question of just how sustainable the dividend really is. Let's dive into the fundamentals so we can try to evaluate that. Dow's free cash flow as of the most recent report was $2.7 billion per share. That marks a consistent decline from its level a year ago at a little over $4.3 billion. So that's a negative pattern. Company's balance sheet shows that cash right now is a little over $3 billion, and that's a modest improvement over the last quarter from $2.9 billion. However, when you compare the current quarter to the last 12 months, we can see that a year ago, cash was about $3.9 billion. That means that we have a negative declining pattern of liquidity in the company's balance sheet. Long-term debt currently sits at about $14.9 billion. That is a modest increase from $14.7 billion a year ago, as well as about $14.6 billion in the most recent quarter. So we have declining cash, increasing debt, and declining free cash flow. All three of these together are warning signs that should be paid attention to. Even more significant from a fundamental standpoint is what we see when we consider the company's operating profile, which I like to evaluate by looking at the company's net income compared to revenues. Over the last 12 months, we can see this number was a very narrow 1.32% and dropped in the most recent quarter to negative 0.99%. Negative 1% doesn't sound like a lot, but the significant pattern here is the deterioration from positive net income to negative. That implies that the company is spending more money than they are making right now. All of these metrics together do suggest that the sustainability of the company's dividend right now should be in question. Doesn't categorically mean that the company is going to have to cut it, but it certainly does raise some concerns. Let's go ahead and take a look at the dividend and see what we may be able to determine from those numbers. With the stock right now at about $54.50 per share and the company's dividend at about $2.80 per share, we can see that the annualized dividend yield for this is a little over 5%. I said 6% at the beginning of this video. I apologize, that was an overstatement. So about 5% right now. That is still very well above the S&P 500 average, which is at about 1.4% right now, and even in line with short-term treasury yields right now, which are in the neighborhood of 5%. That's higher than average, which doesn't automatically mean that it isn't sustainable, but it is pretty normal to see companies, especially in the S&P 500, offering dividends somewhere between 1.5% and 3% as kind of a baseline. So 5% is a little bit out of the norm and is worth paying attention to, not only in terms of being attractive, but also in terms of questioning how sustainable it really is. With that in mind, we can take a look at what the company's history of dividend payouts has been. And since 2019, the company has paid a consistent, steady dividend of $2.80 per share. They've kept that level throughout that time period. That's significant because that includes the chaotic period that was the pandemic of 2020 and 2021. The company did not cut its dividend as a lot of stocks throughout the market did at that time. They kept it at that $2.80 level. The number in the lower left-hand corner of my chart, 224, is referring to the company's earnings per share over the last 12 months. The fact that the dividend is higher than earnings per share is a concern. These numbers are used to calculate what is known as the dividend payout ratio. The math is very simple. We divide the amount of the annual dividend, $2.80 per share, by the amount of earnings per share over the same period, which is 1.25 or 125%. Under normal conditions, I like to see dividend payout ratio of 0.5 or less. In other words, about half of what earnings typically are. When you see numbers in that range, that's usually a good indication the dividend is safe. It's very sustainable, very easy for management to continue to hold. The fact that the dividend payout ratio for Dow is so high is a concern. It does raise the question of whether or not they can continue to maintain this level or whether they will need to cut. However, looking at the company's pattern of holding its dividend even through difficult economic periods and market conditions does imply that the company may very well be able to continue to maintain its dividend at this current level. And the current declines in its overall fundamental metrics that we've already talked about may simply be temporary phenomenon that the company needs to weather. A lot of companies that offer very attractive dividends and have done so for a number of years will not necessarily cut their dividend every time things begin to get difficult. Instead, they will simply try to figure out how to be more efficient and how to weather current conditions while returning the same level of value back to their shareholders. If you believe in the company's dividend and you believe that they're going to be able to maintain it, The next question before you decide to buy the stock should be whether or not it really represents a useful value right now. So let's go ahead and take a look at that real quick. With the stock, as I mentioned already, at $54.50, it currently sits a little bit above the level that my value analysis would offer as a fair value target, which is a little under $50 per share. That means the stock is overvalued right now with about 8.66% downside from its current price at $54.50. We also can see that a compelling discount price is even more significantly below the stock's current price at about $40 per share. None of this is automatically an indication that the stock is going to go down. However, if you're trying to think about what the real opportunity is in the long term, and you believe in the dividend, you would basically be taking that 5% dividend and saying that you'd be willing to go ahead and accept a likely decline of at least 8.66% before the stock begins to reach its fair value price. Your net loss would be a little over 3.5% if that scenario plays out as I mentioned. Dow is one of the companies that I've followed for a long time. I continue to follow it, and it's a stock that I've used in the past to very nice effect. However, in terms of thinking about it as a potentially new investment, right now it's just not the right time. Stick this stock in a watch list and come back to it again at a different point in the future. Thanks everybody. I hope you found this useful. I appreciate your time as always. If you do like my content, please go ahead and click here to subscribe to my channel. You can also check out the videos shown here to see an example of a lot of the other content that you'll see me publish. Thanks again. I'm Thomas Moore. Talk to you again soon.